Hello everybody, good afternoon. I would like to welcome you to this webinar and thank you all for joining us. It's great to have everybody on board. So my name's Carl Taylor. I'm a consultant here at Oldfield Advisory and I'm joined by Joe Brewer, who is consulting partner here at Oldfield too. Hello Joe.
Joining this webinar and good to see so many on the webinar this afternoon. Look forward to sharing these insights with you. Thank you.
So the big question that's really coming up a lot at the moment is how are we going to bounce back from lockdown? How are we going to bounce back from the situation without running out of cash? That's the big question of the moment for a lot of businesses. We ran a poll on a previous webinar that we ran. What we found was that 55% of those on the webinar said that they were going to have tight or severely challenged cash flow over the coming months. So that was kind of quite an eye opener for us, and that was quite a key thing, and we really felt like we needed to address that. We needed to help businesses and our clients and anyone else with their cash flow. So we're just going to run that same poll again, just to get a feel for how everybody's feeling right now about their cash flow and about how it's going to go in the next 6 months. So I'm just going to open up a poll, and the question is, how do you feel that cash flow in your business is going to be over the next 6 months? So if everyone can vote there, you've got 4 options. Is it going to be good? Is it going to be increasing? Is it going to be okay? Is it going to be tight? Or is it going to be severely challenged? So we'll just give everyone a few seconds to get their votes in. Good, that looks like most have voted. Good, I think we're going to end the polling there. So I don't know if everyone can see those results, but it's that's pretty interesting. That's slightly more on this one that are feeling like their cash flow is going to be tight or severely challenged over the next 6 months. So that's really interesting. It's really interesting to get that feedback. So it's still a really important point, and it's something that's really important that we address, because we all know how important cash flow is. It's the lifeblood of every business, and it's going to be the make or break issue for businesses now and in the coming months. Businesses don't fail because of lockdowns. They don't fail because of viruses. They fail because of poor cash flow. And on the flip side to that, the businesses that manage cash flow well at this point in time are really going to be the ones that survive and thrive. So I'm just going to run through the agenda. First, we're going to cover how to avoid some common cash flow pitfalls. So there's really 3 main pitfalls that we just wanted to highlight and really run through how we can counteract those pitfalls, how we can make sure we don't fall into those pitfalls. How to manage working capital, how to stay liquid for the remainder of 2020, and questions and answers at the end. And we're going to have plenty of time for questions there at the end. Just make sure you put them in the Q&A box, the question and answer box. Don't put your questions in the chat box. So put them in the Q&A box. Feel free to put them in as we go through, and we'll do our best to answer those questions at the end. And we will be sending a copy of the slides and a recording of the webinar by email later. So look out for that email that will be coming with a link to those. So just before we dive into the detail, I just wanted to give a really brief background as to who Oldfield are. We've got some clients and we've got some non-clients on the webinar who won't have heard of us before. So just to give the background to who we are. We are accountants and tax advisors based in Coventry. And there's 2 main things that we really help our clients with. We help our clients to maximize profitability and maximize cash generation. And we also help clients with smart tax saving strategies to help them reduce tax liabilities and keep more of what they earn. And particularly at this time, our focus has really been on helping businesses to navigate through today's challenging times. So that's who we are. So I'm going to dive in now to the first part of the content here, how to avoid common cash flow pitfalls. So it's not about being negative, it's just about highlighting the potential pitfalls that we could fall into and just highlighting how we can avoid doing that. So I think everyone would agree that businesses have been going through some unusual times, some unprecedented times. Some businesses have seen sales drop significantly, others have seen sales increase dramatically. But there's really three common cash flow pitfalls that we see that businesses could potentially fall into over the coming months. So I'm going to run through those three pitfalls and talk about what it is and how you can avoid it. So the first one we've got here. So just to give the background, as I've said, some businesses have seen a significant drop in sales. And while it might seem counterintuitive, what normally happens in that situation is that your cash levels or your cash flow actually improves. Sounds a bit strange, but that is normally what happens when sales go down. Your cash levels normally improve. And the reason for that is because your customers are paying you for sales that you've made in previous months. So your debtors level is going down. And at the same time, your sales are low in the current month. So your payments out to suppliers are low. And that means a temporary cash increase. So you can see it on the graph there, on the slides. Your debtors are going down, and that means your cash levels are going up. So it's quite easy to think that everything's okay when that's happening, but really it's not, because your sales are dropping, and that's the reason why your cash levels are improving. So then on the flip side to that, if sales then suddenly increase, you've got the opposite scenario. What's going to happen is your debtors are going to suddenly increase. And that means that cash levels are going to take a hit. So that is just a really important point to watch out for. If we've been in a situation where our sales levels have dropped, we will probably have seen a temporary increase in our cash levels. But just beware that if sales suddenly increase again and we get a sudden upturn, well, the opposite is likely to happen, and you're likely to have a temporary cash knock. So it's really important that you're prepared for that, and you do everything you can to prepare for it and counteract it. So that's the key question. What can we do to make sure we counteract this situation and not be fooled by this situation? So there's really four key points. Number one is put it into your cash flow. So put it into your cash flow forecast. Try out a scenario for a sudden increase in sales and see what that does. See what the impact is. See how much that knocks your cash flow. Then another point is get payments up front from customers. It is possible for that to be done in certain circumstances. It is possible to get payments up front from customers. It's worth doing everything you can to try achieving that, because that will reduce the impact of the situation. The other key point is making sure we definitely have got our debtors under control, and that we've got a really rigorous credit control program in place for the coming months, to make sure we don't let anyone slip through. We don't let any customers off from paying us. It's really important, I think, just particularly at this point in time, and that we're really hot on our credit control. Don't know if you'd have comments on that, Joe.
Certainly endorse what you're saying, Carl, on that point. Yeah, it's more important than ever, isn't it, to make sure that we're getting prompt payment for our outgoing sales invoices right now. So obviously in that situation, it's moving the cash from the customer's bank account to yours. So make sure you've got a good focus on that. You think?
Yeah, that's good. Yeah, I think it's just really important at this point in time. It also reduces the risk as well of bad debts. We want to do everything we can to reduce that risk. And the best way to do that is to be really on top of your credit control, not letting everybody off, not letting anyone off from paying you on time. So that's key pitfall number one, and we've given some key points to take away there to action to make sure we don't fall into that one. Then the next pitfall is not planning ahead for paying deferred VAT. So just the background to this, the government allowed businesses to defer VAT payments that were due between March and June. And they've given businesses until the end of March 2021, so till the end of March next year, to catch up with those VAT payments. Now that's quite far ahead. It seems March 2021 seems like quite far away. And it's just a common kind of pitfall that we could see businesses falling into, is actually forgetting that VAT is due and forgetting that they're going to have to pay that ultimately over to HMRC. So that is just a really important one to think about. If you've deferred your VAT payments, just remember you are going to have to pay them back at some point. And then the other key aspect just around this subject of deferments is if you've deferred any loan repayments, you might have managed to get a loan repayment holiday, or managed to get a holiday on vehicle lease payments, or you might have managed to get a rent payment holiday. Just bear in mind that you are going to have to catch up on those payments in the future. It's just you must just think about that, because don't know what Joel will say on this, but I don't think banks or landlords don't exactly have a reputation for being charitable exactly. Don't know what you say on that, Joe.
Yeah, I think we can all relate to that. There's no compassion when it comes to dealing with banks. And also what we've noticed with our clients is some have managed to secure a rent holiday from the landlord, and that might be for 3 months or 6 months. But what some of the landlords are saying is, oh, by the way, you've got to make up those payments in January next year. So just be careful on that one and make sure that it's in the plan, basically, so that when it comes to January next year, we're not caught out.
Yeah, that's good. So anything deferred will have to be caught up with, will have to be repaid. So yeah, how can we counteract this? How can we plan for this? Well, first thing is, don't forget to include catching up on your deferred VAT payments in your cash flow forecast. You must make sure that's in there. Then on any deferred loan repayments and deferred lease payments or deferred rents, make sure you list those out and see if you can find out what is going to happen to the repayments in the future on those. Either speak to the landlord or finance provider what's going to happen to those payments, and make sure you build that into your forecast too. And then the third point is just obviously depends a bit on what your cash flow forecast is telling you, but you could think about starting to repay your deferred VAT in installments over the next months. Between now and March 2021, you could actually think about paying it off in installments, so it's not one big chunk. So that's key pitfall number 2. So we've highlighted that and given you some key actions you can take away there to make sure we don't fall into that pitfall. And then point number 3, pitfall number 3. There's another common pitfall that we do see some businesses fall into, sometimes without realizing it. And that's running the business by today's bank balance and not looking ahead. So just really wanted to highlight this pitfall and make sure anyone that's on this webinar avoids this. I think it's easy sometimes just to log into the online banking system or look at a bank statement, look at your bank balance and maybe sort of breathe a bit of a sigh of relief that it doesn't look too bad today, and go by that to run your business. But that really doesn't tell you anything about your profitability. It doesn't tell you anything about your balance sheet. It doesn't tell you anything about your equity. And it doesn't really tell you anything about what's going to happen by the end of the day, or what's going to happen tomorrow or next week or in the next 6 months or 12 months. So I don't know, Joe, if you would have any comments on that.
Yeah, I think it's particularly pertinent that we don't run our business just by the bank balance. We have seen that quite a few times. Particularly relevant, isn't it, where you're receiving deposits up front or stage payments or something like that. You can just open up, the bank and have a look at the balances and think, I'm absolutely fine. We did have a client quite a few years ago, and they were running quite a sizable contracting business. It was actually block paving business, quite a sizable setup. And if you think about contracting with the public, at the end of it only takes 3 days to kind of block pave someone's drive. And at the end of that time, this guy was taking payment at the end of the job. If you could picture that, just stand there, wait for your money as soon as the job's finished. He was taking 30, 60 days to pay his suppliers and any subcontractors he was using. And sure enough, he had a lot of money in the bank, and sure enough, he was spending it. He's increasing his drawings, buying new vehicles, new equipment, nice new car and a few trucks, this sort of thing. And the problem then came when his sales slowed up, his sales dried up. There were no more prompt payments coming in from customers. He suddenly realized the money in the bank had all gone and he'd got 2 months worth of suppliers to pay and just didn't have the money to do that. So I'm only just saying that as an illustration. Can't run your business by just looking at the bank balance. It's not going to work. You need to look at the financials. What are they telling us? Are we moving forwards or moving backwards? And also, more importantly, having a proper cash flow forecast. Like it's been said, if we fail to plan, we're really planning to fail. Do you think, Carl?
Yeah, that's good. It's just particularly at this point in time as well. We really don't want to be running our business by the bank balance right now, because it could be deceiving you just at this point in time, particularly if you've had a temporary, drop in sales. As we've said before, it could just be deceiving you. So you must make sure, to counteract this, we must make sure we're looking at our balance sheet on a regular basis, looking at what our equity is, looking at what's happening to our assets, looking at what's happening to our liabilities. And that will really tell us, and looking at what our profit and loss is, that will really tell us what's going on, really. And the other key point, as you said, Joe, is really planning ahead, having a forecast. That's the best way to counteract running the business by today's bank balance. So they were the 3 key pitfalls that we just wanted to highlight, and then we've given you some key actions to counteract those and make sure you don't fall into them. So I'm going to hand back over to Joe, who's going to be talking about how to manage working capital when bouncing back. So I'll hand over to Joe.
Thank you, Carl. I think that was quite insightful. So in order to manage working capital, firstly, we need to understand it. And there's a couple of ways to help grasp the concept of working capital. One is working capital cycle, or can be expressed as cash lockup days. That's obviously expressed in number of days. And the second way of looking at it is working capital cost, which is actually expressed as a percentage of sales. And we'll explain these in more detail as we go through, but these are particularly relevant in a manufacturing business, or indeed in any business that buys and sells a product. So where you're buying and selling a product, maybe processing it, you will have a working capital cycle, and there'll be a cost of actually servicing that business in terms of working capital needed. So if we can go on to working capital cycle first, as I say, that can be described as cash lockup days, and I actually prefer that way of describing it because that's exactly what it is. It's the number of days that your cash is actually locked up in the company. So cash lockup days is the combination of your stock days. And for those who don't know, stock days means the average number of days that of stock that you've actually got on hand. It's a combination of that plus your debtor days, which is the average number of days that your customers are taking to pay you, and your creditor days, which is obviously the number of days on average that you're taking to pay your suppliers. So it's really the number of days, cash lockup days is really the average number of days from when you pay for your purchases to when you receive money from your customers. And therefore it illustrates the length of time that your money is not in your bank account in that whole cycle. So for example, you might hold 60 days worth of stock, that's 2 months worth of stock on average, and your customers might take 60 days to pay you on average, but you may have to pay your suppliers in 30 days. So to calculate your working capital cost, working capital cycle, or your cash lockup, you add the stock days and the debtor days together, and then you subtract the creditor days. So in this example, 60 days plus 60 days minus 30 days equals 90 days cash lockup. So from that, you can then calculate what you need to do. You might say on bounce back, what funding you'd need and how long you'd need it for. So if you take an example of suddenly your sales going back up again, in this situation, you've got a 90-day cash lockup. It's going to be 3 months between paying out for a fresh, you might say, warehouse full of stock and actually being paid for that stock, if that makes sense. So working capital cost is really the same calculation, only it's more in monetary terms. So there you add your stock and debtors together. So what I'd suggest on this is probably take it at the end of your last financial year, at a time when it's more stable, more usual performance. Add your stock and debtors together from your balance sheet and subtract your trade creditors. And that gives you a working capital figure, which you then divide into your annual sales figure. So that's expressed as a percentage. So assuming you've got £1 million worth of working capital and your sales are £4 million, just to make the figure simple, you would have a working capital cost of 25%. So now you know that to grow your business, every £1 million you want to grow your business, you will need an extra £250,000 worth of working capital. And that's got to be funded from somewhere. So whether that be external finance, or you might come out of a reserve account, it might be private money put in, but more pertinently, just right now, it's probably, do I take advantage of the cbos loans or don't I? And that, if you know that number, if you're expecting a bounce back that's quite significant, this will help you calculate how much you need to borrow. So don't kind of just go by gut feel, you're going by actual fact. I don't know if you got any comments on that, Carl, as to that working capital percentage.
No, just that it's a really helpful percentage to know, isn't it? It's really good to boil it down to a percentage of sales, because that makes it a real tangible number that you can work out. So it's something that is worth everyone just going away and doing. Just go and calculate what is your working capital cost. What is that cost as a percentage of sales? And it just means you can then really easily assess, if our sales go up by a certain amount, how much cash is that going to use up? So I think it's a really helpful percentage to really know and have at your fingertips.
Yeah, that's good, Carl. So we then thought, having got a grasp of working capital, we'd go on to explain 3 ways to improve the cash lockup period of time and the working capital cost. So you may say these are quite simple points, but points that business owners often overlook. So we thought it was worth just spending the time to go through them. First one is lean stock control. Obviously, reducing your stock holding improves the cash lockup time and the cost that brings to your business. So just on that point, obviously, it's very important to stock what you sell and sell what you stock. We've been told that many times. Make sure that your stock holding is really relevant to the next 6 months. Make sure you're stocking what you're going to sell, what you're going to be able to sell, but make sure it's lean as well, so that whilst you're not running out of key items, you're actually reducing surplus stock and bringing stock down to a manageable level. The more you can reduce stock, obviously, it shortens the cycle and also puts cash in your bank. Number 2 is debtor collection. So systematized and relentless debtor collection is very, very important. Reducing your debtors, as we've said already, really moves cash from your customer's bank account into yours. Very important in terms of reducing that working capital cost. So don't be pushed around by large companies who want to set their own terms. Make it clear from the outset. It's really part of the sales process. Make it clear right from the outset. This is the way we operate. This is the way we do things around here. Our terms are whatever your terms are. And make sure that you know, obviously there's negotiation involved in all of this, but make sure you set out your stall as early as possible in the sales process. Rather than letting these big corporates dictate, you know, we always pay 90-day terms and so on, because that's obviously going to stretch out your cycle and also cost you a lot of money. Creditor payments, ask for better terms with suppliers. Establish credit accounts where you haven't got them already. And that's particularly pertinent when it comes to overseas suppliers. What we're finding increasingly is that the world is becoming a smaller place, and just because a supplier's overseas doesn't mean that you don't have a credit account with them anymore. Ask for credit. You know, it's a competitive market. If they want to sell the goods as much as you want to buy them. So again, say, look, you know, we need credit facilities here. And if you can get credit facilities, that obviously reduces the working capital cost and the number of days lockup, which is all very important if we want to grow our business. And time, I might say time is urgent. We want to grow our businesses fast in this situation. So hopefully those points help. And just wanted to add one further point before handing back to Carl. One interesting point is, in the current situation, you might have someone on your workforce that's not fully utilized right now because of the current situation. Maybe they're still furloughed, or maybe you're struggling to keep them busy. Get them back working and developing a slick automated debtor collection system. So in your software, your accounting software, you'll probably find this facility in there to generate auto reminders, statements, letters, you know, preempt the situation by sending out pre-letter, what we call a pre-letter. So it goes out ahead of the time, and you're setting out, these are the invoices that are due on the 30th of June, for example. Please contact us now if you have any query. All of that can be automated in your system. So get some, you know, someone of your team, whilst they've got time to do that, get them to set all that up. Also consider, you know, getting them on the phone. Anyone that's underutilized, get them on the phone. Again, proactively collecting money. So we don't necessarily mean just chasing money, although that's needed, but ironing out the queries. So, you know, these accounts are falling due at the end of the month. Have you got any queries? Are they approved for payment? Are they you're sure they're on the payment run for the 25th of June or whatever that customer normally does. So very, very important, do you think, Carl?
Yeah, definitely. I think we couldn't really overemphasize it just right now. No, that's good. They're helpful, practical points we can do to help improve our cash lockup cycle or reduce it, and reduce our working capital cost. So the third part that we were going to be talking about, the third agenda point, was just how we stay liquid for the remainder of 2020. It's obviously going to be challenging times. There's no secret about that. It's not necessarily going to be easy. But as we've said, it's really the businesses that manage cash flow well at this point. They're really going to be the ones who survive and thrive. They're going to be the ones that get through this and are able to come out the other side and are able to, continue to grow and invest in opportunities as they come up. So how do we ensure we've got enough cash to stay liquid for the rest of the year? It's a big question. But really the first step that we've got to take is to look ahead and do a cash flow forecast. That's really the only way you'll know what the situation is going to look like. It's really the first key step that we have to take. I think it's really critical that every business has a month-by-month cash flow forecast for the next 6 to 12 months, so we can really see, how are things going to look. Businesses that don't do this, we couldn't really guarantee how they'll survive the challenges of the next few months, and we couldn't really say how they're going to fare. Can't really guarantee that they'll survive. Businesses that do it, on the flip side, will be in a really strong position. Things aren't certain, things are uncertain, and it probably will be difficult to project and plan out what your sales are going to be. But the thing to do is to try out different scenarios, try different levels of sales. If you've tested those different scenarios, you'll be in the best position to take action well ahead of time if sales unexpectedly increase again, or if they unexpectedly drop, or if they continue at the same level as they are right now. So, if we don't do that looking ahead, if we don't sort of apply ourselves to doing that looking ahead, we could end up getting caught in a cash flow crisis. And that obviously brings a lot of stress and distraction with it. And it can end up damaging your reputation with customers and suppliers. And it can end up wasting a lot of time. You can end up wasting a lot of time fending off overdue supplier payments, which is a complete waste of time. And it can cause a distraction, a headache and a distraction that means you don't have the focus on sales and business development that is really needed right now. And it can obviously end up meaning the business has to close. So that's the impact if we don't look ahead, if we don't forecast ahead and plan ahead and look at what is going to happen, what's potentially going to be the situation. So on the flip side, it is far better to have looked at it ahead of time. Far better to have a month-by-month cash flow forecast that tells you what the future trends are going to look like. So you can plan ahead, you can look ahead and act ahead of time. So you don't get caught out in a tight spot. You can anticipate where the tight patches are going to be. You can say, okay, September looks like it's going to be a tight patch. Looks like we're going to be struggling there. That means you can take action to mitigate that problem. You can look at obviously getting additional financing. You might need to put a bit of money into the business, whatever's needed. But you can take that action ahead of time. As we said, you can test the scenarios. You can see what different levels of sales will do to your cash flow. So you'll know what it will look like if the worst happens and also if the best happens. And it means you can then see what your finance requirements are. You can see whether you actually need a bounce back loan or whether you need a cbos, a coronavirus business interruption loan. It means you can look at that and see, will we need one of those over the next 6 to 12 months? And it means you can get that sorted ahead of time while those sources of finance are still available. You can use your forecast to make that decision intelligently. And so then that gives you the space and the time and a clear head, so you can really focus on sales, business development, contacts with customers and potential customers, and you don't have to be distracted or worried about the cash flow aspects. It really gives you that time and space. Don't know, Joe, what you'd say about that?
Yeah, certainly, Carl. Totally agree with that. We've seen it so many times that there's nothing more draining to a business owner than actually being short of cash, and it influences your decisions, doesn't it? So, you start buying smaller consignments of stock, or you start doing things that aren't for the long-term good of the business just because you're short of cash. So very important to stay liquid and stay in a position whereby you've got time and space to make decisions and grab opportunities. So if you've got cash in the bank, you can move in and maybe acquire a small business or something like that along the way if it's up for sale or the owner's struggling. Add it to your own business. There's just so many reasons why we want to be in a healthy cash position. And how do we know if we are or not? I think that's the question, isn't it? So this is really the way to find out, is by having a clear plan, and we can clearly see if we've got a clear roadmap ahead of us in terms of cash flow. We know how to track against that, whether we're doing well or whether we're not doing well. And we can see the end result, the end of 12 months, this is how it's going to look. It gives us confidence, basically.
Yeah, exactly. It gives us that confidence. We know what it's going to look like. We can sort it now, if you like. We can sort any cash flow problems out now by planning ahead for them. And then that really gives you time and space, and it gives you opportunities. So cash flow forecasting is going to be critical now and over the next few months, and it's something that we can help businesses with. It's something we're very passionate about, is helping businesses to see ahead, to achieve this. And if you'd like to look at the options for getting cash flow forecasting in place for your business, then we'll be more than happy to talk about it. You can book in a free action planning call following this webinar. There'll be a link for this in the follow-up email. You'll be able to just get some time scheduled in with us, and we can just talk about your situation, find out what's going on, and see if we can help get a cash flow forecast in place, give you peace of mind over the next 6 to 12 months. So just going to move on to the questions and answers. Got some time left for questions and answers. So, okay, let's have a look at these questions. Good. So, question here. I'll read out the question, and so everyone's got that. How should you forecast sales on a cash flow forecast when things are so uncertain? Don't know what you'd say to that one, Joe.
Yeah, that's a very good question. Things are uncertain, that's clear, but it's difficult to know, obviously, what's likely to happen in detail over the coming months. But the best thing is to try and do, would you say, different scenarios? So try a best case scenario, which could be surprisingly good. We've got a lot of clients that are actually already experiencing very, very high level of inquiries, and they're almost struggling to keep up already. So try a best case, try a middle of the road sort of, you might say a prudent middle of the road forecast, and then try a worst case, say, what if this doesn't pick up as quickly as I'm anticipating? I think the answer is to try different scenarios, what's going to happen in each of those different circumstances, and then you'll know what action you need to take if the sales are at any of those levels. What would you say?
Yeah, exactly that. I think that's the thing. That's the power of it, isn't it? Is looking at different options, looking at the best case, looking at a middle of the road scenario, and then looking at the worst case scenario, Trying those different ones out, you can see what's going to happen in those circumstances, and you can take action ahead of time. You'll be able to get a feel for, actually, look, it feels like we're heading down the worst case scenario at this point in time, where we need to take the action that we said we would take for that. So totally get where that question is coming from. Things are so uncertain, it's difficult to know exactly what your sales are going to be tomorrow, let alone for the whole month. But just try out the different scenarios, and that will put you in a really strong position. Another question we've got here. How long are cbos and bounce back loans going to be open for? It's a bit of a rhetorical question, that one, I think. We're not too sure. There's nothing publicised on that as to how long that finance is going to be available for. But what we would say is, if you haven't already, do your cash flow forecast now. Try out the different scenarios and assess what your finance needs are going to be. And look at it now, and get any extra finance that you need sorted now, ahead of time, and while it's still available. Okay, some more questions coming in here. Okay, another question we've got here. For those not accustomed to borrowing, is it good to say that a reasonable overdraft facility can be helpful, where you only pay interest on the fluctuating balance? So, don't know what you'd say to that one, Joe.
Yeah, thanks, Carl. I might wrap it up with the next question as well, which is about releasing funds from existing assets, actually borrowing against asset. If that's okay, I'll just wrap it up in one answer. Okay. I think my own feeling is overdrafts have their place, but I'm increasingly cautious of overdraft, actually. I think the safest way of borrowing right now would be to go for the bounce back loan or the cbos loan. And we can just touch on the difference on that briefly, or Carl can. The reason for that is there is actually no cost really in taking out loans at the moment under those government schemes. The bounce back loan, there's no arrangement fees, there's no interest to pay initially. And you can also repay without any penalty at any time. So I would rather go the route of a loan. And also to point out that an overdraft facility, whilst the bank may grant that to you, don't forget that every year the overdraft facility has to be renewed. And we've seen this quite a few times, that it comes round to the next renewal date and the bank want to reduce the facility. So they're actually on a mission. Some of the major banks are on a mission to reduce the amount they're lending on overdraft and increase the amount they're lending by way of a loan. So I've always thought, in recent times at least, I've always thought that borrowing against an asset is the safest way, which I think really covers the other question as well. You're much safer having an asset and a loan that kind of matches up with that asset, if that makes sense. An overdraft is just, you might say, general borrowing. And personally, I just don't like it because it feels like the bank have got control. Whereas if you take out a loan, you're signing an agreement and the bank are signing the same agreement. It's a commitment both ways. If you like, the bank are committed to giving you that money for 5, 6 years, whatever you take the loan out for. Does that make sense? Whereas an overdraft is renewed every year and they can recall it without warning, even unfairly. You know, they can just recall it. Does that help, Carl?
Yeah, that's good. Yeah. Yeah. Helpful points.
Want to just touch on the difference between the bounce back and the cbos loan, just for those.
Yeah, it's probably not time to literally go over all the details just right now. We've got an article on the website which just sort of compares the overall features against each other, and you find those details on the British Business Bank website as well. Yeah, I mean, that's another question that we just got here, is about which is the right one, bounce back or CBILS. There's just a question really of looking at the level of finance that you're going to need to see you through. So as we said, do your cash flow forecast, look at what the situation is going to be like, look at what finance you're going to need, and then you can see what kind of level of finance you're going to need. Obviously, bounce back loans, just the key difference. The bounce back loans obviously they're a limit of 50k, and they're limited to 25% of your turnover, up to 50k. Whereas CBILS is there's much more scope with that. You can get borrowing up to 5 million under CBILS. So obviously subject to meeting eligibility criteria, etc. So I think that's the answer to that one. Good. I think that is all the questions here. Just one other question just before we finish, just to round off. Should we have a weekly or a monthly cash flow forecast? It's a good question. Should we be trying to forecast out what's going to happen on a weekly basis, or should we just focus on a monthly basis? It's really just a question of what capabilities you've got in-house, really, because I think the starting point really is the monthly cash flow forecast. That's definitely the first step, and because that lets you see the overall trends for the next 6 to 12 months, and you can look at the scenarios and different impacts on a monthly basis. Gives you steer about what you need to be doing over the next 6 to 12 months. The weekly cash flow forecast is really more of a sort of granular thing that we would expect somebody in-house in your finance team to do, based on, a bit more of a hands-on approach, just based on what they know in terms of what customers have got to pay us and who we're going to have to pay in the next few weeks. We have got a template for weekly cash flow management, which is on the website. So hopefully that answers that question. Good.
Just another question come in, Carl, about the, I think this is around having money in the bank. With the uncertainty of all banks surviving this downturn, what guarantees do the government give to a business balance if a bank collapses? And is this safer when you have an overdraft rather than a cash balance resulting from a premises or bounce back loan? Would you like to venture an answer to that one? The safety, I think it's around the safety of the banks and what happens if you've got a bank balance, actually cash in the bank.
God, Joe, I think you've probably got the answer to that one up your sleeve.
Well, obviously the bank, the government do have the scheme where they deposit protection scheme, so that you will be covered up to £85,000 per bank, if you like. So if you've got a substantial amount of money in your business, it is a good idea to spread it, isn't it, Carl, over several different banks so that you're covered by that scheme. I think right now the banks are reasonably strong, both in terms of cash and also in terms of their asset rating, you might say, their equity. So it's not like pre-GFC where some of these banks were already in difficulty before that came along, and that was just really like the final straw. I won't pretend to be an economist because I'm not, but I understand it's different at this point in time. So I don't think we need to be over anxious. If you have taken out a CBILS loan, for example, and that means you've got a loan on the one hand and cash in the bank on the other, personally I wouldn't worry right now. But if there ever were concerns about the banks in the future, the worst that can happen is you quickly repay the loan and reduce your bank balance. isn't it? Because I understand there's no penalty for repaying those loans. Is that right, Carl? So you could quickly remedy that situation, I think. But in principle, yeah, you know, if you have got substantial bank deposits or deposits with the bank, consider spreading them over several banks, because the government scheme is per bank. And there's a few questions coming in here about, do we have a template for cash flow forecasts, which I think probably watch out for the follow up to this webinar, watch out for the copy of the slides. And it's really down to the fact, would you say, your earlier point, Carl, do you have the capability in-house or not? Do you think, is that the key to it?
Yeah, that's right. Yeah, it's cash flow forecasting is a specialist area, and it's you know, it does take experience and to really build up the ability to build a cash flow forecast that will represent an accurate assessment of the future trends.
Yeah, someone's saying our cash flow, we do cash flow forecasting, but it's very inaccurate. Well, yeah, I mean, this is why I think we need to take this seriously and consider getting some expert help on it. If you think that's fair, I think it's one of the lifeblood of a company, so it really is very, very important. We don't run out of cash in the next 6 to 12 months.
Good. Excellent. Well, I think that's the questions answered. So thank you very much, everybody, for joining us. I'm really pleased to see you on here this afternoon, and look out for the follow-up email, and we'll keep in touch. Thank you very much.
Thank you.